You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you're doing well on this Wednesday. Yesterday, I discussed a big question about whether or not Dollarama is a dividend stock. And actually, I went a little bit wider in this discussion where is a company paying a yield under 1% should be considered a dividend stock. So for Dollarama, the answer to that question was yes. And I would say that it's pretty much always the same. Today, I wanted to circle back on this question and discuss a little bit more. What is the difference between a high yield stock and a low yield stock? And the point here was more to find a very solid business that has been paying 4 to 5% yield, sometime a little bit more than that over the past 10 years, instead of like going for like an easy victim of a high yield that eventually cut their dividend. And then that would have been like very much like cherry picking. So I decided to discuss Canadian Utilities. It is a dividend king, so over 50 years of dividend increases. There are only two companies that achieved this milestone in Canada. So Canadian Utilities, CU.TO, and Fortis, FTS.TO. And I've discussed Fortis this very Monday, actually. So those are the only two companies showing more than 50 years of dividend increases in Canada. It's pretty rare. So we are really talking about a solid business. Regulated utilities are great because they provide constant cash flow. It's easy to manage. We all need power. So pretty interesting business here. And the classic comparison that I make in many of my webinars is, would you invest rather in Canadian Utilities or in Alimentation Couche-Tard, ATD.TO? Why Couche-Tard? Well, mostly because it is a good representation of those low yield, high dividend growth type of business that I like. I could have selected Stella Jones. I could have selected Dollarama. I could have selected like a lot of other great companies in Canada offering a yield that is usually under 1%, but showing incredible great metrics. So the comparison that I usually make is, well, if you want to retire on ATD, you're going to get a yield of 0.90% right now. On top of that, it's not a good year. The stock price has declined since their peak in 2024. So usually it pays more a yield around 0.75. If you retire on Canadian Utilities instead, well, the company has been getting a pretty good year so far. So it's interesting to make the comparison when ATD is going down while CU is actually going up. So the current yield's at 5.05%. So if you want to get as much yield, as much dividend as you would have get with Canadian Utilities, you need 5.5 years of ATD's dividend to equal only 1 year of CU. So from that perspective, if you just focus on the dividend income, of course, you're going to pick Canadian Utilities. There's absolutely no question here. 5.5 years to get only 1 year of dividend from the other option. Why would you even consider ATD, right? But let's take a pause here and let's introduce the magical concept of total return, because when you invest in something, you just don't invest for the dividend. You also invest for the value of your capital. So imagine that you have invested $100,000 10 years ago. Well, you have like two options to retire on today. One will give you $438,000, so that would be the capital appreciation plus the dividend accumulated during those 10 years. And the other option would be to get a box where you have $141,000. So how comfortable would you be to retire with 141 versus 438? I mean, we're not talking about like a small difference here. We're talking about $300,000 difference, right? That's kind of crazy. I'm pretty sure I don't have to tell you that ATD, total return, has been a lot better than CU. But when you look at what created that total return, it's even more interesting. And this is where we're going to see what's the difference between a high yield stock and a low yield, high growth company. So ATD's total return is a combination of the stock price appreciation and a growing dividend. Of course, the dividend is not significant. It's a small one, but still it is a growing dividend over the past 10 years. And on top of that, you have stock appreciation. When you look at Canadian utilities, if you take away the total return and you just look at the stock price, it's actually slightly down. So investing in Canadian utilities over the past 10 years was a pure play on dividend payment. So what's the difference? Well, on one side, we have a management team that created value for shareholders. It means that Alimentation Couche-Tard actually made more revenue, made more profit, and created more value for shareholders, while CU's management failed doing so. They just kept on that boat rolling, paying the dividend, and that's it. Which is not necessarily a bad thing by itself, but it's important to understand where the profit, where the total return, where the dividend is coming from. So over the past 10 years, ATD earnings per share grew by 342%. So you can see that there is definitely directly a link, a correlation that is almost like 1-for-1 between the earnings per share growth of 342% and the investment growth going from $100,000 to $438,000. So there's definitely a link here, right? Well, what about CU? Well, nothing. Like the EPS grew by -1%. So not even a growth here. And that explains why the stock price is slightly lower than 10 years ago. And the only difference that you get is you get the dividend. So is it normal that the stock price stagnated? Of course, the company's not making more money per share than it was 10 years ago. So there's no reason for you to pay a higher price today, right? And that is including, I have to repeat, that is including that ATD is not on a roll right now. It is going through a tougher phase, which is completely normal. And you cannot expect a company to grow double digit every single year. So this is one of those years for ATD. And on the other side, with the interest rate cuts and the progress that Canadian utilities did, well, the stock price has been like recovering nicely, because if I had done this comparison about 6 or 9 months ago, that would even been worse. Imagine that. So the difference between a high yield and a low yield, high growth stock is most of the time other financial metrics. It's just the difference between a stable / mature / probably struggling business versus a thriving business, increasing sales, increasing profit, and of course, increasing the dividend. So then thriving businesses tend to attract investors a little bit more. So the yield is just a function of the demand for the stock. If there's a strong demand for a stock, chances are the stock price will go up and then the yield will be reduced accordingly. While if there is a weak demand for a stock, probably because the business is going nowhere, therefore less demand, the stock price doesn't move that much, and then the yield goes higher. So what was there weak demand for a stock versus another? You can ask yourself that question, why most investors would prefer to invest in a thriving business than a struggling one. Well, I think you have your answer here. So that's why it's a little bit harder to invest in high yielding stocks and still getting your dividend, protecting your income from inflation, and still having a thriving portfolio over the long run. There are some exceptions, of course. There are some great companies, but in general, if you go above 5%, it's going to be tough to find a thriving business. Now, I get that if you're about to retire, retiring on a low yield forces you to sell shares, and that's a problem. It's a problem when the share are going down, because then if you sell at a bad timing, well, you're going to put your retirement plan in jeopardy. And if you retire on ATD, you'll be forced to sell some shares at one point. So that's not working well, right? But there are solutions. There is a way that you can shape your portfolio, protecting your portfolio from selling at a bad timing and still have have a better, healthier portfolio with a set of companies that are actually thriving instead of struggling. I'm explaining this in my new webinar this Thursday on moosemarkets.com/webinar. So if you register, even though you cannot attend the live session, you will also receive the replay. So you can go at moosemarkets.com/webinar. This is where I will explain how you can build a thriving portfolio even with a lower yield at what you need to retire and still not having to stress when it's time to sell shares. So go to moosemarkets.com/webinar. We're going to see you tomorrow, but don't forget that I will still have another interesting podcast. Tomorrow, we're going to talk about, can those high yield and low yield cohabit in your portfolio? In other words, does it make sense to invest in Enbridge and Dollarama in your portfolio at the same time? So we're going to talk about that tomorrow. But until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.